There are many things to consider when it comes to deciding on how to finance your next car purchase. PCP agreements have become very popular. I looked at some stats earlier on saying that over 1/3 of new cars are now PCP agreements, and that stat was from a couple of years ago, so God knows what it is right now. As with everything, there are positives and negatives to going with PCP for your finance. With the PCP financing, you don't actually own the car outright during the term of the agreement, only at the end of it if you decide to pay the final large optional payment. So that means you are restricted in that you cannot sell the car during this term. At the end of the usual 3-year term, you have 3 options. You can either hand the car back, you can buy the car outright with the optional payment at the end, or else you can enter into a new PCP agreement. What I really want to focus on in this video is what is the cheaper option from a finance perspective. Are you better off going with a PCP arrangement or getting an actual bank loan? If I wanted to get this beast of a Toyota Yaris in the morning, would I be better off getting a PCP arrangement or a bank loan? Let's run through the figures now and see what actually costs less. So the road price of this Yaris is €22,070, and for this example that I'm going to use, I'm going to assume for both the PCP and the bank loan that we put up a deposit of €5,000. So that leaves an amount that we need to get financed of €17,070. Now the APR rates that were being offered by Toyota were 4.9% for a 3-year term. Then on a 5-year bank loan, the rates vary from bank to bank, but you can get roughly a rate of about 8% APR at the moment. So what I'm going to do here in this example is compare where we are in both positions after 3 years and see which has been cheaper. So these were the PCP terms. As I was saying here, the road price was 22k. We paid a 5,000 deposit and we needed to get 17k financed. That worked out as a monthly payment of €262. And as we said, this is over 3 years and it has an APR of 4.9%. So that leaves a cost of credit of €1,972. At the end of the 3-year term, you have the option of buying this car then at a price of €9,482. If you wanted as well, you could just hand the car back and then pay nothing more. For the bank loan then, as we said, we need to finance €17,000. So I've put an interest rate there of 8%. Hopefully maybe you can get a rate slightly better than that. But they are pretty much the going rates in Ireland here at the moment. So this is over 5 years, as I said, and this works out as a monthly payment of €346. So as you can see here, the monthly payment is much higher with the bank loan compared to the PCP agreement, which was only €262 per month. So straight away, you're going to be paying more per month on your bank loan. So now I just want to compare the situation after 3 years. So for both the PCP and the bank loan, we put up a deposit of 5k, and the payments we made so far up to the end of the 3-year term were all of those monthly payments. So for the PCP, it added up to 9,500, and for the bank loan, which was higher, it added up to 12,460. So there were extra payments of 2,900 made on the bank loan. To own the car outright at that point on the PCP, you had an option to pay €9,482. That's to buy yourself that car at the very end of the PCP agreement. So that brings you up to a total cost of €24,042 if you're trying to buy the car through PCP. If we compare that to the bank loan then, after 3 years, there was €7,653 left on the loan. So if at the end of the 3 years you decided to pay off all that loan in one go, your total cost would have ended up being €25,113, which ended up being €1,071 more. Essentially, all of this difference is down to the higher APR rate on the bank loan, which was 8% versus the PCP rate of 4.9%. So that is really what was causing the difference here. And for my example here as well, I'm assuming that there has been no extra penalties or charges for poor condition of the car or going over on your mileage. So this 24k figure here for the PCP could be higher if you get stuck with some penalties. If you did get stuck with a few £100, it would definitely bring the cost of both of them a lot closer. A lot of people may be happy to pay that extra few quid if it means that they actually own the car outright by getting the bank loan. Another very important thing to have a look at here is the equity left in the car at the end of 3 years. So let's say, for example, this Yaris is actually worth €11,000 at the end of 3 years. So that would mean there's equity left in the car, meaning the value is greater than the cost that you have left to pay on it. So what does it mean to have equity on your car in terms of a PCP? So when you have equity left, so this car, for example, in the PCP agreement had equity of €1,519, which was the difference between the value of it on the market and the optional final payment amount of €9,482. Out of the three options that you have at the end of a PCP agreement, the worst option you can possibly take is to just hand back the car, because you're going to lose that $1,500 of equity. You would be better off if you could get the money together for the €9,482. Then you could sell the car on the market for $11,000 and get your £1,500. Another option that you will have, is which a dealer will probably suggest, is to use this equity that you have left in the car and put it towards your next PCP agreement. So that $1,500 can go in as your new deposit. There is also a potential to have negative equity though. This is where your final payment that you have to make is actually more than the market value of the car. I just want to talk about one risk that I see with these PCPs is if you don't have that €9,500 at the end of 3 years, you're kind of stuck between a rock and a hard place. You have to either enter into a new PCP agreement, or else you have to hand the car back and lose out on the €1,500 equity that is left in it. And also, if you haven't been saving up a bit of money over the 3 years as well, you won't have anything to put forward as a deposit for your next PCP agreement, and that will mean you will end up paying higher monthly payments every month. So you could easily end up in a cycle of getting caught in these PCP agreements one after another. I'm sure you could also try and get a loan at this point and pay off that €9,482 as well, just if you were really stuck. But a lot of people probably just take the easy option and go into the next PCP agreement and start paying higher payments, and the cycle can kind of continue. So my summary of all of this has been pretty basic, and it will change if you have different APR rates for different loans and different PCP agreements, so you have to take that into account. But generally, bank loans will have higher monthly payments and will be more expensive up to the 3-year mark due to the higher APR on bank loans. The car is yours with a bank loan and can be sold at any time, unlike a PCP, so you definitely have a lot more flexibility. And as I was saying, if you can't get enough money together at the end of the PCP to pay the balance owed, you either have the option of walking away and losing the potential equity left in the car, or also ending up in another PCP agreement with higher payments. So that is pretty much it for my video on this today. I would love to know your thoughts on it. When you go for car finance, what do you go for yourself? Do you go with a bank loan? Do you go with a higher purchase? Do you go with a PCP? If anybody would like to see me do more videos on car financing, then please let me know in the comment section. I could do some videos on higher purchases versus bank loans and other things like that. So thanks very much for watching. I hope you enjoyed the video, and if you did, please make sure to subscribe so you can keep up to date with my latest videos.